Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com, or whatever your favourite podcast platform is. This is episode number 29 in our series for 2025, and today's date is Friday, August the 29th. First, I'll be talking to Nicholas Woodward, the country manager of Pack&Send, the company that provides customised logic solutions for businesses of any size, and that has helped countless Australian businesses pivot and grow. We'll talk about Pack&Send's international growth as a franchisor and the growing importance of e-commerce in the business model of parcel delivery. And I'll be talking to AMP Capital Chief Economist Shane Oliver about the latest profit reporting season. But first, let's talk to Nicholas Woodward.
Nicholas, when did Pack&Send begin, and when did you actually start with the business?
Yeah, Pack&Send started 30 years ago as a single outlet in Parramatta, New South Wales, Australia, and we've now grown to 125 outlets in Australia. I joined the company back in 2005, so when it was much smaller, and have been around since then, and I'm currently the country manager running Pack&Send in Australia, New Zealand and the United Kingdom.
So you've been there for quite some time, and what have been some of the biggest milestones for the organisation?
Yeah, some of the biggest milestones, we've won a few accolades along the way. International expansion for us was a great milestone. That happened many years ago, and as I mentioned, we're in 3 countries now. We were also fortunate enough to win Franchisor of the Year as an acknowledgement of the strength of our franchise model. And most recently, we've been announced Product Review Courier of the Year for the 4th time, which again, it's a great accolade for the business, testament to our franchise partners and the customer service they provide on a daily basis.
Okay, so how do you find working over such wide geographies?
Yeah, the markets are all different, but there's a lot of similarities as well. So our office is structured where we have our global head office in Sydney, Australia, and then we have operation in New Zealand based in Christchurch, and then also one in the United Kingdom based in Reading. Our network size in New Zealand is 20 service centres, and we also have 20 service centres in the United Kingdom as well.
The freight sector's gone through a lot of changes in recent years, and so what do you see as the future of the freight sector?
Yeah, the future of the freight sector, it has been a remarkable period in its history. I was reading a report from Pitney Bowes the other day, and the parcel volume sector, it's expected to double. So if you think about the sheer volume of parcels now being moved around the globe, that will continue to be sustained long into the future. Really, the future of the industry is in a few areas. I would say sustainability is a big one for the sector. If you think about the usage of trucks and depots and aircraft and so on. So the sector needs to ensure that we have a sustainable future, and we're doing our part. Also from a packaging perspective, ensuring that there's full sustainability of packaging materials used. And of course, electric vehicles is a big one, and it's very topical at the moment. But in addition to that, I would say the use of AI is also an emerging trend within the sector. Now, I'm not talking about driverless vans and trucks and so on yet. We may see that long term, but AI for the industry, it's more about predictive modelling for demand forecasting to ensure that there's the right density of vehicles and trucks and so on to ensure that the delivery timelines are met.
So it would actually be crunching all the data for that?
Absolutely. So it's crunching the data of previous experiences through trends and peak season and Christmas peaks and so on, and really utilising AI tech to determine, well, how many drivers are required to handle the volumes, how many trucks are required, etc., etc.
Has franchising changed in the years that you've been with the company?
Yeah, franchising, I guess at its fundamentals, it's remained the same in terms of franchisees being provided with a reputable brand and business system. But there have been some trends throughout in my time in the brand and in the sector. One of those is the increasing regulation, ensuring that franchise systems are at a certain level and they're transparent and they do operate based on the code of conduct. The other one is the amount of due diligence our franchise partners now do on the business. And that's not just assessing the financials, but it's talking to others in the network, ensuring that they've got full confidence when they come into the business. And the other trend I have seen is is more and more franchise partners now starting with one as, say, an owner-operator, but then looking to expand to buy another franchise or to expand into a new area under the same brand. And we now have many franchise partners that have 3 or 4 different outlets under the same brand, so they can really maximize their investment and the synergies of owning more than one business.
So they actually run and expanding businesses themselves?
Yeah, correct. So they start with one, they operate that successfully for a period of time, and then look for other areas where we're looking to expand the brand. So some of our franchise partners at Pack&Send may have a retail service center, and then they might, in a new area, open a logistics facility so they can handle bulkier goods or provide fulfillment solutions for their customers. So it's a great expansion model for them, for their own investment as entrepreneurs.
And give them a chance to actually not only expand their business, but change their business models along with that.
Yeah, definitely. That's right. We can provide the full service through our retail service centers, no matter how small or big. But the bigger facilities and having multiple locations can help them expand their capabilities for their customers as well.
But, if someone moves from, say, flat out delivery to logistics, you would be able to assist them with that?
Yeah, definitely.
Because you have the systems all set up for that.
Correct. Yeah, so our systems let them manage that, no problems at all.
Any tips for anyone wanting to get into franchising?
Yeah, tips would be do your research, of course. And if you have the possibility, be a consumer of the brand that you're interested in to ensure that you love the values and you can see the culture and see yourself wearing the shirt proudly. The other thing is definitely chat to other franchise partners to ask their experiences to get a feel for their journey. And that's a great way to get a good cross section. And that doesn't just mean the one down the road, organized through the franchisor to chat with, say, someone else in another part of the country. And as I say, it is really a case of ensuring that this is something that you'll be living and breathing this for the next number of years as an investment in the future, but also as an entrepreneur. So it's a case of ensuring that there's a strong passion for the brand and for the work that'll be done.
Would you say the level of due diligence that franchisees are now going through has increased over the last few years?
Yeah, definitely. So both financial due diligence and also legal as well has definitely increased. And franchisees, they're looking for confidence in the brand and the system. At Pack&Send, we have been rated a 5-star franchise system by an independent assessment company called Frandata. So having that sort of information does give them a lot of confidence when they are doing that due diligence, and chatting about the model with their accountant or with their legal advisor to ensure that they're making the right decision for them.
So where do you see the direction that Pack&Send is heading over the next 5 years?
Yeah, so Pack&Send in Australia, we have 125 locations, like I mentioned. We see that growing well beyond 150 in the next few years to our long-term ambition, which is over 300 locations. And that combines retail service centres, logistics service centres that are bigger operations, as well as having locations in more regional and rural markets as well. One of our biggest growth areas is in the e-commerce third-party logistics area, providing customers with an e-commerce shipping platform that we call Pack&Send Live. And that enables online retailers to handle their shipping through our technology and, if required, utilising our locations as fulfillment centres as well. And we see that as a big growth area for our business, us providing the end-to-end fulfillment solution for retailers, so we can organise to bring their containers of stock in, store the stock across our network, and then organise the pick, the pack, and the last mile of delivery to ensure that the retailer's customers, the receiver, gets a superior customer experience.
Could you see the e-commerce taking over?
Not taking over, because a big part of our business continues to be B2B type services for our local business customers. So that could be dealing with art dealers, antiques, IT and electronics, printing shops, marketing agencies, and so on, that require a full service shipping solution. So that business will remain, and we expect that to grow. But on top of that, a big growth area is this e-commerce part of the business that we've seen in recent times.
And would you see that globally?
Yeah, definitely. It is very much a global trend that we're seeing, that in each of those markets, the exact same thing's happening. The boom in e-commerce, the person who started off selling things online in their out of their lounge room and their garage, expanding to a self-storage facility, and then looking for storage, warehousing and fulfillment space. And many of those have now turned into substantial businesses that require a complete solution, but they don't have the expertise in logistics themselves, and they're not big enough to hire a logistics or procurement manager. So many of those companies are looking to outsource that to a brand such as Pack&Send, where we can provide the full solution.
So you would have a whole lot of commonalities among your franchise partners?
Yeah, definitely. So they can provide services, and we also, across our franchise partners, can provide a national solution where a single customer could hold their stock in multiple locations across multiple franchise partners. And then our technology enables the franchise partner who has the stock closest to the end receiver to fulfill and dispatch those goods. So definitely there's a lot of synergies across our whole network that really provide benefits for our end customers.
Well, Nicholas, thank you very much for your time. Really appreciate it. Thank you.
You're welcome, Leon. Thank you.
And now let's talk AMP Capital Chief Economist, Shane Oliver.
Well, Shane, what's your take on the profit reporting season?
Well, so far so good. It's only early days. We're still only around 30% of companies having reported, but the results that we have seen have been quite reasonable, which is good. Some good results from some of the consumer stocks like JB Hi-Fi, Nick Scali, REA, talking about a stronger property market. Banks still seeing record profits. So that's all good news. On my take, so far we have seen more companies surprise on the upside than the downside, about only marginally. 24% of companies have come in better than expected versus 19% worse than expected. And that's a good outcome. But of course, the bulk of companies are in line, which is a bit unusual to see so many companies in line with expectations. I guess the good news, though, is that 78% of companies have seen earnings rise on a year ago, which is better than normal. The normal pattern is about 57% of companies see profits up on a year ago. And 68% of companies have raised their dividends from a year ago, which is above the norm of 59%. So that's overall, it's a reasonably good result. We're still on track, I think, for a fall in profits for the last financial year. The consensus is around 1.6%. A week or two ago, that was for a fall of 1.7%. So it's improved marginally, but it's still pointing to a fall in profits for the third year in a row. But I guess the good news is that the rate of decline seems to be at least slowing. And of course, expectations remain for some recovery in profits over the current financial year, which of course is what's buoying the share market. That's why we've got the Aussie share market at or around record highs.
It's good, but it's been patchy as well.
Yeah, there have been some misses there. There's no doubt about that. Some big downside surprises. And of course, I should also point out that it's often the case that Nick Scali and JB Hi-Fi come up with good results. That gets everyone excited. And then as the reporting season rolls on, for some reason, companies that report through the last 2 weeks, and of course, we're in the big week now. I think there's something like 82 major companies this week and 70 major companies next week. They tend to disappoint. So it'd be dangerous to read too much into it just yet. But at least there are some positive signs there. And I think what's happening is that the rate cuts are buoying confidence a little bit, and that may help. But flip side is interest rates are still relatively high compared to where they've come from over the last few years. And Australian consumers are still feeling fairly wary about things as their budgets got stretched over the last couple of years with the cost of living problems. So we've still got a way to go, but I'm reasonably confident we've seen the worst in the last financial year and should see better conditions this year. But I'm also conscious that a year ago there was a similar expectation for the last financial year, and it turned out to be another fall.
Of course, everyone's expecting the RBA perhaps, maybe, to cut interest rates.
I'd say it's more of a possibility. Well, last look, there is a much bigger chance that they'll cut in November, where it was about a 70% chance of a cut coming in November. So our base case is they'll probably leave September and they'll continue with this cautious approach, which is basically one cut every 3 months or every quarter and cut again in November. And we also expect more cuts coming through in February and May next year, taking the cash rate down to 2.85%. So we certainly got some good news last week in regards to the RBA, that they did cut. Of course, their own forecasts are predicated on further cuts. In other words, if we don't get those further cuts, then growth will be weaker than the already subdued numbers they're forecasting, and unemployment higher and inflation will be lower. So our view is that, yes, we will get more cuts, but they're going to come gradually.
So how do you see the reporting season stemming out over the next 2 weeks?
Look, to be honest with you, I think the next 2 weeks will probably be a little bit rougher than the last week has been. I think that's the experience of these things, but I think it'd probably still leave in place consensus expectations for a third year of falls in the last financial year. So we'll probably see profits down 1.6% in line with that, or maybe a little bit worse. But by the same token, I think there'll just be enough in there from outlook statements and companies that are doing well to leave optimism that profits will start to rise again in the current financial year. So don't expect the results to be as good as they have been over the last week or so. They historically tend to get a little bit worse in the final weeks.
But how does it compare to last reporting season?
Well, the last profit reporting season saw a fall of around 5% in company profits. So that was mainly for the last financial year. So I suspect this time around it's probably not as bad. There is a bit of light at the end of the tunnel, and that's maintaining a bit of optimism around out there. And that's probably why the share market is feeling a lot more assured this time around, although some might say that it's running on hot air. But in the 23-24 financial year, profits were down 54%. We then got the December half reporting season, which did show some signs of optimism and improvement, but it wasn't significant. In fact, we had roughly the same number of profit beats as we had misses, and profits still remained pretty subdued. This time around, we do seem to have started off a little bit stronger, so that's a good sign. But I think it just means that profits will still be down for the financial year, just not down as much. You've got to also remember here that the main source of weakness, and it's a similar story in the US actually, the main source of weakness is in resources stocks, where profits are running down. If you look at the energy stocks, that's the big drag, where profits are probably going to be down 17% or so. Then you've got materials down 16%. Most other sectors are actually seeing gains in profits, apart from the consumer stocks where it's becoming less negative. But most other sectors are seeing gains, particularly financials are around 8% profit growth this financial year, IT 26%. Similar story in the US, but of course the IT sector in the US is far bigger than it is in Australia, so that's tipping their profits into positive, whereas we're still negative because IT is not as big in Australia. Telcos, profits up there, so it's mainly the weakness we're seeing in Australia is mainly in the resources sector, which is coming off those very high commodity prices of a few years ago and dragging down profits in that sector for I think it's the second financial year in a row. So, but outside of the resources, it's actually not too bad. Overall, it's still one of declining profits.
Indeed, and so the next profit reporting season is early next year. How do you expect that to be?
Well, with a little luck, we'll see signs that profits are starting to pick up by then. We are forecasting a bit of a pickup in economic activity in Australia. Most recent growth number was 1.3%. By the end of the year, that could be 1.8%. So a bit of a pickup in economic growth, hopefully stronger consumer spending, and that obviously should help company profits. And if we see a stabilisation in commodity prices around current levels, then it also helps the resources sector, which has been the big drag. So I suspect we'll see a modest pickup in profits. And indeed, that's what the share market is depending on. Unlike in other countries, or the US in particular, where the share market gains to record highs in the US have been underpinned by profits. And there's even a bit of debate about that because the share market has run ahead of profits and PEs are well above normal levels. But at least you've got that profit growth coming through. Whereas in Australia, we haven't had that. So our share market's managed to move ahead because prospects for lower interest rates and prospects, therefore, for stronger profits ahead. And that's what we're going to have to see. So I think it's critically important in the next reporting season to see profits pick up. And I think we probably will see some pick up. It just remains to be seen how strong that will be.
Well, Shane, it'll be fascinating to see. And thank you very much for your time.
So what's happening in the news? Well, President Donald Trump has said he will immediately remove Federal Reserve official Lisa Cook from her position, a major escalation in his battle against the US central bank. In an announcement made on his social media platform Truth Social, Trump informed her of his decision to remove her from the bank's board of governors with immediate effect. He said there was sufficient reason to believe she had made false statements on mortgage agreements and cited constitutional powers, which he said allowed him to remove her. Neither Cook or the Federal Reserve has commented on the sacking, which the President announced late on Monday. Trump has put increasing pressure on the Fed, especially its chair Jerome Powell, in recent weeks, over what he sees as central bank's unwillingness to lower interest rates. He's repeatedly floated the possibility of firing Powell. His decision to fire Cook, who is one of 7 members of the Fed's Board of Governors and the first African-American woman to serve in the role, is believed to be unprecedented in the central bank's 111-year history. It is also likely to raise legal questions, with experts suggesting the White House will need to demonstrate potentially in court, that it had sufficient reason to fire her. The President had called for her resignation last week over the allegation of mortgage fraud, which was first made in a public letter from housing finance regulator Bill Pult, a Trump ally, to Attorney General Pam Bondi. The housing finance regulator called the letter a criminal referral and urged the Justice Department to investigate. It is not clear whether an investigation has been opened. Cook said last week that she learned of the allegations from the media, and the matter stemmed from a mortgage loan application she'd made 4 years ago before she joined the central bank. "I have no intention of being bullied to step down from my position because of some questions raised in a tweet," she said. "I do intend to take any questions about my financial history seriously as a member of the Federal Reserve, and so I'm gathering the accurate information to answer any legitimate questions and to provide the facts." If Cook or the Fed resist Trump's decision to oust her, experts suggest it could trigger a standoff between the central bank and the White House. The Fed gained independence from the US government in 1951. Trump has expressed increasing animosity at Powell, calling him a numbskull and a stubborn moron because he did not support the president's call for rapid large cut to borrowing rates. But last week, Powell boosted expectation there will be an interest rate cut in September. Speaking to central banks gathered in Jackson Hole, Wyoming, he also argued that the inflationary impact of Trump's tariffs could prove temporary. The US dollar weakened against major world currencies in Asia, trading on Tuesday, as investors bet that Cook's replacement would be likely to push more interest rate cuts. And Australia Post has immediately suspended most postage to the United States, with only delivery of letters, documents and gifts worth less than $150 continuing. The Postal Service has taken the extraordinary step to halt many forms of postage to the US, as a Trump administration tariff on low-value parcels is due to come into effect within days. Australian businesses selling to American customers will be blocked from shipping to the US via Australia Post. The government-owned Postal Service joins other global carriers in taking this step ahead of new levies beginning on Friday, February the 29th. It will continue shipping letters and documents to the US along with packages that are declared as gifts and are worth less than US $100. That's $153 Aussie. And it's finally happened. The long-promised overhaul of Australia's broken environmental laws, cited by Ken Henry as the nation's most pressing productivity challenge, will be brought forward by almost a year, piling pressure on business, miners, environmental groups and the Senate to reach an agreement before Christmas. Following discussions at last week's Economic Reform Roundtable, the Albanese government has decided to put the legislation to Parliament by the end of this year, not the second half of next year as originally flagged, in a bid to land the reforms that bedevilled its first term in office. Former Competition Tsar Graham Samuel reviewed the Environment Protection and Biodiversity Conservation Act, the EPBC, introduced by the Howard government in 1999. Samuel, who handed down his findings in 2020, declared the Act an abysmal failure in that it was failing to safeguard against wanton habitat destruction and was also leading to protracted approval processes for mines, housing and other developments. Environment Minister Murray Watt, who was appointed by Albanese to negotiate a compromise between business and environment, said, "It was clear from last week's roundtable that there is very strong support across business, environment and community representatives for serious and urgent reform to deliver stronger environmental protections, faster and simpler project approvals and greater transparency in environmental regulation." Watt, who was handpicked by Albanese after the election to take the environment portfolio from Tanya Plibersek and land the reforms, has done little else since but focus on the task, including about 45 stakeholder meetings. In those meetings, I've consistently heard that we need to move quickly to reform these laws, as delays mean holding up investment and more environmental destruction, he said. The basis of the reform recommendation is to streamline approval into a single decision-making process based on national environmental standards rather than dual state and federal processes. Put simply, it's about being able to give a project application a quick yes or no. And the states and territories stand to lose up to $18 billion in extra funding for their hospitals over 5 years if they refuse to sign up to a new plan to stop children with mild autism and other minor developmental issues from accessing the National Disability Insurance Scheme, which already costs more to run than the aged care system and Medicare, and which is forecast to cost more than the age pension. Under a deal with the states signed in 2023, children with mild issues for whom the NDIS was not designed were supposed to be shifted to state-provided foundational supports by July the 1st, 2025, in return for $13.2 billion in extra hospital funding between 2025 and 2030. But no state signed up, and that deadline was missed. So last week, Health Minister Mark Butler announced a new national foundational support scheme known as Thriving Kids, towards which the states must contribute 50% of the cost. It will begin on July the 1st next year and be fully operational a year later. However, due to increasing medical costs and the passage of time, the $13.3 billion in extra hospital funding between 2025 and 2030 has now blown out to about $18 billion between 2027 and 2032. Chalmers told the ABC's Insiders program on Sunday the extra hospital funding was still contingent on the states playing ball with the Commonwealth to alleviate the burden on the NDIS. As always with Commonwealth-state financial relationships, there's a bit of back and forth about how we deliver, but that agreement was struck, he said, of the December 2023 National Cabinet deal on the NDIS. And French giant Lactalis will become the largest dairy company in Australia with a purchase of Fonterra Cooperative Group for $3.4 billion. Fonterra has agreed to the sale of its global business to Lactalis, including its operations in Australia, Oceania, Sri Lanka and the Middle East. Fonterra owns well-known brands Western Star Butter, Perfect Italiano and mainland cheeses. That will now be owned by the French. Lactalis is already the largest dairy company in the world. Its chief executive, Emmanuel Besnier, said combining with Fonterra would allow the company to grow in key markets. With this acquisition, we significantly strengthen our strategy across Oceania, Southeast Asia and the Middle East, he said. Fonterra and Lactalis need further regulatory approvals in Australia and overseas for the sale to go ahead. Fonterra's dairy farmer suppliers in New Zealand will also vote on the acquisition later this year. The sale is expected to be complete in early 2026. And the Insurance Council of Australia is warning insurers to proceed with caution on the rollout of AI. AI is already being used by insurers to predict natural disasters, help staff analyse claim documents and streamline interactions with brokers. And at results briefings this month, Suncorp said it had more than 100 AI models in development and will discuss plans to roll some of them out at an investor day in late October. Insurance executives envision a near future where a customer takes a smartphone picture of their crashed car or burnt out house and submits it via an app for assessment by artificial intelligence software, which will either automatically pay out the claim or reject it without human intervention. Yet while the potential time and cost savings from such technology are clear, the Insurance Council of Australia is urging its members to work carefully when they use AI. End-to-end automation is exciting, but it also comes with the risk of getting bad customer outcome, says ICA Chief Executive Andrew Hall. If we rush and break trust, it will set us back because the instinct for government will be to regulate. And it's the final week of the profit reporting season. Supermarket giant Coles unveiled a 1.8% lift in sales to $44.49 billion as net profit fell 3.5% to $1.079 billion. Woolworths, the nation's largest retailer, has posted a 17.1% fall in normalised net profit to $1.39 billion. Fruit, baked beans and juice company SPC Global suffered a loss of earnings before interest, taxes, depreciation and amortisation of $3.5 million for the 12 months ended June 30, compared with $10.6 million a year earlier. For the year ended June 30, medical gloves and surgical gown manufacturer Ansell's statutory net profit rose $99.2 million, up 17.7% from $84.3 million a year earlier. Queensland export terminal Dalrymple Bale Infrastructure delivered a 17% rise in interim profit to $43.1 million. Chorus said it was back in the black with a net profit after tax of $4 million New Zealand dollars compared with the $9 million New Zealand dollars loss in FY24. Reese's net profit after tax dropped 24% to $317 million from $419 million in FY24. NIB net profit after tax for FY25 rose to $198.6 million from $181.6 million in FY24. Campervan Group Tourism Holdings, which is dual listed on the NZ and Australian Stock Exchanges, reported a full year loss in 2024-25 of 25.8 million New Zealand dollars compared with a net profit after tax of 39.4 million New Zealand dollars a year ago. Investigation software provider Nuix reported a net loss after tax of $9.2 million for the year compared to a profit of $5 million in the prior year. Adore Beauty delivered a record EBITDA of $8.1 million, up 67.8% on the prior year. Bendigo and Adelaide Bank has reported a statutory net loss after tax of $97.1 million for the year to June 30. WA lithium miner Pilbara Minerals has posted a statutory loss of $196 million. Aussie Broadband reported NPAT of $32.8 million, up 24.5%. Navigator Global Investments has reported a 26% increase in full-year adjusted earnings of US $114 million. That's 177 million Aussie dollars. Endeavour Group's net profit fell 15.8% in the past 12 months to $426 million. ASX-listed alternative asset manager Regal reported a 24% decline in normalised net profit after tax to $44.81 million over the half year. Abacus Group reported a statutory net profit of $26.9 million. Mining tech giant Imdex reported an underlying earnings before interest, taxes, depreciation and amortisation of $126 million, which was below its figures for FY24. Online marketplace Kogan.com has slumped to a net loss of $39.465 million for fiscal 2025. Lindsay Australia posted an underlying EBITDA of $81.4 million, down 11.7%. Normalised EBITDA was $33.264 million, down 10% on FY24. PeopleIn posted a 10% decline in normalised EBITDA of $33.3 million. Gold miner Ramelius Resources reported a full-year net profit of $474.2 million, more than doubling last year's result of $216.6 million. Cinema and Hospitality Group EVT has delivered a full-year net profit after tax of $33.4 million, up from $4.82 million in FY24. Medical device manufacturer PolyNovo announced a full-year net profit of $13.2 million, which was 151.2% higher than the $5.3 million profit in FY24. Software provider Infomedia booked a full-year net profit of $22 million, up 6% year on year. Southern Cross Media's underlying net profit rose to $15.1 million, marking a $10.6 million increase from the previous financial year. AUB Group posted a 17% rise in underlying net profit after tax to $200.2 million for the 2025 fiscal year, up from $171 million a year earlier. Reported profit rose to $180.1 million from $137.1 million. West African Resources booked a $215 million profit after tax in the June half, up 133%, underpinned by strong gold sales and higher prices. G8 Education reported statutory net profit after tax of $22.5 million for the half year ended June 30, 2025, up 12.4% on the prior comparable period, with operating EBIT rising 2.8% to $40.5 million. Fortescue Metals reported a net profit after tax of US $3.4 billion, that's $5.2 billion Aussie for the past financial year, down 41% on the previous year. Nanosonics EBIT almost doubled to $17.8 million, with profit after tax up 59% to $20.7 million. Petrol and diesel supplier Viva Energy, which owns a Shell-branded network of petrol stations, reported that its net profit on a replacement cost basis, the figure most closely watched by the market, dropped to $62.6 million in the 6 months ended June 30 from $192.1 million a year earlier. Johns Lyng net profit fell from $63.3 million to $54.1 million. Hello World Travel lifted its profit by 4.1% to $33.2 million in the 2025 financial year. Centre Group, operator of Westfield Centres in Australia and New Zealand, reported a statutory profit of $782 million, an increase of $177 million. Australian business technologies leader Data3 reported that its gross profit was up 7.3% to $289.7 million. Digital lotteries reseller Jumbo Interactive saw its full-year net profit fall 7.3% year-on-year to $40.2 million. Tyro Payments has posted a statutory net profit after tax $17.8 million, down from $25.7 million a year prior. Bus and ferry operator Kelsian Group has delivered a year-on-year decline in net profit of 6% to $54.49 million. Ingenia Communities' underlying profit was up 33% to $126.1 million. EBOS Group's net profit fell 20.8% to $215.1 million New Zealand dollars. Meridian Energy recorded a net loss after tax of $452 million New Zealand dollars compared to a net profit after tax of $429 million New Zealand dollars in FY24. Sigma Healthcare's EBIT was up 32% to $767.9 million. Troubled pizza chain Domino's Pizza has swung to a loss of $3.7 million, its first as a listed company. Flight Centre posted an underlying profit before tax of $289.1 million for the 2025 financial year, down 9.8% on the previous year. Tabcorp's net profit after tax before significant items jumped 76.8% to $49.5 million, while statutory profit recovered to $36.6 million from a $1.36 billion loss in FY24. Neuron Pharmaceuticals reported a first half profit after tax of $15 million, up from $8 million in the same period last year. WiseTech's net profit after tax rose 17% to US $200 million. Worley Group's underlying earnings rose 10% to $823 million. Homewares retailer Adairs Group's earnings before interest and tax declined by $6.8 million, down 36.6%. Nine Entertainment's profits were $194.4 million, down 10%. Counter-drone technology group Drone Shield swung to a net profit of $2.1 million compared with a $4.8 million loss a year earlier. Fashion jewellery retailer Lovisa posted a net profit of $86.3 million, up 4.8%. Cash Converters reported a 41% rise in full-year net profit to $24.5 million. And that's it for this week. And next week I'll be talking to Mark Washbourne, the co-founder of ASX-listed tech company ReadyTech and software innovations like JobReady, which matches job seekers to find positions, and its student management system. And I'll be talking to RMIT economist Sinclair Davidson about the outcome of the government's tax and productivity roundtable. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com, or whatever your favourite podcast platform is. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X as it's now known, Instagram, LinkedIn, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles, or advertorial, email me. Looking forward to the next episode of Talking Business next week.